So is the so-called Sell America trade back on? Let's get more from Karl Schamotta, Chief Market Strategist at Corpay. Great to see you.
You as well.
That downgrade by Moodys of America's credit rating seems to have sparked more fears over the deficit.
Yes, I think the downgrade was sort of widely expected. That was something that had already happened at other ratings agencies. It is very clear that debt in the U.S. is on an unsustainable trajectory. But the progress that Republicans are currently making in pushing a bill through the House, which would add materially to U.S. fiscal deficits over the next decade, that's really worrying. I think a lot of investors at this point, the projections suggest that you're looking at another 3.8 trillion to 5.5 trillion that would be added to U.S. deficits over the next decade. And a lot of the spending is sort of front loaded. So, they're putting a lot into the economy on the front end. They're proposing to reduce taxes very materially, which would boost growth. Spending is remaining relatively high, especially on the defense side. And everything that is supposed to, balance this out is going to happen on the back end. And so, unfortunately, the way bond markets are looking at this, it does look as if you're looking at a lot more issuance in the years ahead. And that means that the private sector is going to be forced, especially in the U.S., to absorb a lot more debt.
Looks like the 10-year bond yield, it has gone up, but it's still shy of the 30-year yield.
That's right. So we're seeing what we call a bear steepening, right, where the long-term yield goes up by more than the shorter-term yields do, which historically typically indicated a rise in inflation expectations, right? You would typically see that sort of pattern playing out because you thought inflation would be more elevated over a long period of time. But today it does seem like it's reflecting deeper worries about the U.S. itself. And so, fundamentally, if we look at all of this, this is a reflection of growing concern in global markets about the U.S. itself, right? About the exceptionalism that, sort of underpinned U.S. growth for the last decade and a half. That flow of foreign cash that was coming in now looks like it's going to be much more diversified. It's going to, we're going to see investors around the world parking money in other jurisdictions like Europe and Asia. And that means that, not only does U.S. growth potentially slow and potential growth slow, but also that the private investor in the U.S. is going to be forced to absorb so much more debt. And that means, fundamentally that rates have to go up.
Let's have a look at the U.S. dollar, maybe a 5-year chart for the U.S. dollar. So this is certainly on the surface bearish for the greenback.
Yes. The interesting thing, of course, here is this is long-term bearish. It does suggest that, over the next, 5 to 10 years that investors diversifying outside the U.S. are not going to be lifting the dollar by as much, right? If you look back at the last couple of decades, because the U.S. was essentially the only game in town, investors around the world were constantly bidding up the dollar, and that helped to drive that overvaluation. Now we think that that's going to unwind. However, in the near term, the dynamics might not play out quite so cleanly because you are looking at a U.S. that is, potentially stimulating its own economy, using that borrowed money essentially to juice growth in the short term. And so, I would say that it's safe to take a relatively bearish long-term view, but the short term, especially the next couple of months, could get quite bumpy, and you could see the U.S. dollar, post a couple of rallies in that period.
I'm just trying to think if these tax cuts are inflationary in the United States and if America does experience inflation because of tariffs, and that seems...
It would add to it, yes. So, if the government is essentially taking less money out of the economy, that provides a similar stimulative effect to what happened after COVID, right? It's not to the same degree, it's not to the same scale whatsoever. And these tax cuts are far more beneficial for people on the upper end of the income spectrum who have, typically a lower marginal propensity to spend money. But, it is overall stimulative. And so that adds to the pressures that you were discussing earlier in the program where, these big retailers in the U.S. are saying we are going to pass on these price increases that we're suffering as a result of tariffs. We are going to push those out into the economy. That added to, big inflationary, a big rise in inflation expectations among U.S. consumers, as well as more money in the pockets, could mean that prices, remain relatively elevated. And so what does that all boil down to? That means that the Fed can't ease as quickly as had been anticipated.
And might even have to hike, I suppose, if inflation heats up sufficiently.
If it did, yeah. I think overall the prognosis of most economists at this point is that we're going to see the U.S. economy itself slow, that overall demand will be slower, but it won't be as slow as had been anticipated. And so that just means that the Fed has to stay on hold for longer. I don't foresee hikes anytime soon, just because the overall effect of what's going on is likely negative, and that means less heat in the economy that the Fed needs to take action against. So all of that is interesting from a currency perspective because it means that real yields, inflation-adjusted yields in the U.S. remain high, and that means that rate differentials, which typically support the U.S. dollar, are going to remain supportive for a while. So if we get past this little period right now where people are really fearful about long-term U.S. assets, we could actually see the U.S. dollar outperform a little bit.
I know we're getting political here, but do you think there's a sense in which the Trump administration is seen as undermining the rule of law? I mean,
yes.
Political directions to the Department of Justice?
No question. I think at the end of the day, that pattern of behavior that had existed for a couple hundred years in which, there were sort of norms around the U.S. political establishment. There was, a protection of independent institutions like the Federal Reserve. All of that being rolled back is bad for, global investment demand. If you're an investor who's looking to park money for 20, 30 years, which, big real money investors are, you're definitely going to look at the U.S. with a more, skeptical eye after all of this, right? And I do think, that this is part of what we're seeing in global markets is just those big real money investors saying, yeah, the U.S. might still be the fastest growing in the global economy in the long run, but we need to spread our bets a little bit and make sure that we're diversified into some of those other areas like the Euro area, like Japan, et cetera.
The old cliche, you shouldn't invest somewhere where you wouldn't go on holiday. And I guess a lot of people are saying, well, I don't want to go on holiday in America right now.
Definitely true for a lot of Canadians.
Anyway, Karl Schamotta will join us very kindly for a second block after this. Karl is Chief Market Strategist at Corpay. We're going to talk about the Canadian dollar and oil prices.